darker red bars are showing our estimates of the amount of debt that's coming back. And this is not the level, this is the change in the level. So these are increments of extra debt that has to be refinanced. If you get a problem in the repo markets, you'll start to see repo spreads blowing out. And this is the repo spread against Fed funds. Now, if this is a barometer, or even if you like a sort of a heart monitor of the system, you'll see that we're starting to get some pretty scary readings coming up. And the point to note is not necessarily the spikes, the scale of them, but the frequency. Because what this is saying is you've got increasing tensions. Now, we understand fully that repo markets tighten at the end of each quarter and they need liquidity. But the point here is that you've got a trend. And what's happened in the last week is you've seen spikes in repo. You've seen the Fed's standing repo facility, which is an emergency financing tranche, being used quite heavily twice. And you've had Jay Powell, the Fed chair, de facto announce on Tuesday that quantitative tightening was ending. And disjoin the dots here. There are problems with liquidity in the system. It's beginning to roll over. And you can see this evidence in the chart. And that is what we've really got to be very, very alert to. The system needs more liquidity. The bottom line is that simply ending QT is not enough. They're going to have to do a lot more than that. Now, this is the other thing which we need to monitor. And this may be the dog that hasn't barked yet in sort of Sherlock Holmes terms. This is move volatility. It threatens to spike upwards if you get bigger problems in the repo and bond markets. It hasn't yet. It's beginning to lift off a little bit, but I think the authorities are keeping this under a lid, so they're massaging it downwards as best they can. But nonetheless, this is something which needs watching, although I accept it hasn't moved yet. This is the growth of Fed liquidity prospectively, and this is showing what is likely to happen to Fed liquidity over the course of the next 6 months. Now, Fed liquidity was an aggregate we devised back in the late 2010s to try and understand what the Federal Reserve was really doing in terms of liquidity injections. The balance sheet wasn't really good enough as a measure through this QE, QT phases, and you needed a more precise aggregate, which we devised Fed liquidity. Fed liquidity can be estimated by everybody from the weekly 4.1 H4.1 press release that is delivered by the Federal Reserve at 4:30 Eastern time every Thursday. We show it here. This is the growth rate. We've projected it into 2026. You can see that what is happening prospectively is a significant shortfall in liquidity. In other words, it falls, absolute drops. The previous 2 times that it did that was not very good for markets. And that's what we've got to be alert to. But even if the Federal Reserve stopped its QT policy, that orange line would still decline. It would see probably half the decline that you've got there, but it certainly wouldn't go positive. And that's one of the things to be alert to. What are the risks of this? This is the risks that we need to be also very alert to and up to speed on. This is looking at the movement in excess reserves of US banks. This is based on our calculation of what excess reserves are. We think that the adequate reserve level for US banks is about $3.3 trillion. The Federal Reserve thinks it's about 2.7, so about $500 billion less.